question is this. If the yen keeps weakening while real wages are only gradually improving, can Japan's equity rally still be treated as a clean weekend trade? That is the change from yesterday. Yesterday, the market was focused on the intervention clock. The Nikkei rose strongly, topics joined the move, and dollar yen stayed near 161. 5. The question was whether investors were still willing to buy Japan while currency officials were watching. Today, dollar yen is closer to 162. 1. The Nikkei rose another 47%, and topics gained 86%, so the equity bid has not disappeared, but the story is becoming less simple. The weak yen is doing two things at once. For exporters and global earners, it can support earnings translation. It can make foreign revenue look stronger in yen terms. It can also keep overseas investors interested in Japan as a market with currency-linked earnings leverage. But for households, a weak yen can raise import costs. It can keep pressure on food, energy, and everyday prices. That is why today's wage news matters. Japan's real wages rose for a fifth straight month in May. That is a positive signal for the domestic economy. But the gain slowed because inflation is still taking a bite. So the question is no longer just whether the weak yen is good for listed companies. The question is whether income growth is strong enough to absorb the weak yen's cost. The top news flow remains focused on foreign exchange. One story framed the yen's fall as a deeper debt and credibility issue. Another focused on Japan's FX messaging and the way intervention risk is keeping traders nervous. The market takeaway is that intervention risk is still present, but it has not stopped yen weakness. Verbal pressure can affect positioning, but it has not changed the basic direction of the trade. That creates a difficult setup for equities. If the yen weakens gradually, investors can treat it as an earnings tailwind. If it weakens too far, it raises the chance of intervention or sharper policy pressure. And if it keeps feeding inflation, it can undermine the consumer side of the Japan story. That is where fast retailing becomes today's stock to watch. Yesterday's stock lens was Toyota. Toyota was useful because it showed the exporter side of the weekend trade. If the yen is weak and stable, a global manufacturer can benefit from currency translation and overseas competitiveness. Fast retailing asks a different question. It is one of the Nikkei's most influential names, so it matters for the index. But through Uniqlo, it is also a consumer company. It sits between global earnings, yen-related cost pressure, and domestic purchasing power. That makes it a cleaner lens for today's market. If investors keep rewarding a company like fast retailing, while real wages are positive but inflation remains sticky, they are saying Japan's consumer story still has enough resilience. They are saying the rally is not only about exporters. If domestic demand names start to lag, while currency-sensitive companies lead, the message changes. It would mean the market is becoming more dependent on a narrow weekend earnings story. The next signals are dollar yen, topics breadth, and the performance of consumer-facing stocks. If dollar yen stays high but topics continues to participate, the market is saying the weekend cost is manageable for now. If the Nikkei rises but breadth fades, then the rally becomes more vulnerable. For now, Japanese equities still have support from firmer risk appetite and the softer yen, but the character of the rally is changing. Japan is no longer only an exporter and currency translation story. It is becoming a test of whether wages, consumers, and policymakers can live with the same weak yen that investors are still buying.